Hello, everyone, and welcome to this edition of The Final Bar. It's Wednesday, February 28th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you all week from a very sunny and beautiful Dubai. This has been an absolute pleasure to get to know the people of Dubai, people from all over. I mean, it really is a salad bowl mix of people from all over the world doing a lot of really interesting things and a fantastic scene here. So it's really been joyful. The CMT Dubai Summit just started last night, and I had the pleasure of moderating a panel with Gina Martin-Adams of Bloomberg, Dr. Mohammed El Sayed of HC Brokerage in Cairo. Had another panel that went afterwards, which was absolutely fascinating, featuring Gautam Shah, top technical analyst in actually originally from India, now based in Dubai. Bloomberg's oil and gas expert. It was a lot of fun. I mean, just a really fascinating discussion, some really thoughtful questions. I'll share with you some of the high-level takeaways that I had after yesterday's session, and after I record the show here, I'm going to get ready in a couple hours, kick off the main day, which is all day today here in Dubai. But let's talk about the U.S. market and how things played out through the course of the trading day on Wednesday, February 28th. Let's get to our market recap. So as we're looking at the S&P 500, a choppy day, right? I mean, if you look at the last 2 days, choppy is the way that I would probably describe it. The S&P 500 down about 0.2%. The NASDAQ composite down just below 15,500, and that's down 0.6%. The Dow almost flat for the day. So the NASDAQ, sort of pulling the markets lower. And you'll notice here in a moment the worst performing S&P sector, communication services, one of the bigger weights in the NASDAQ. Here we can see also below there, mid caps flat for the day, small caps actually down. We highlighted on yesterday's show, a bit of a rebound in small caps and speculating as to whether that might be the beginning of something a little more significant. Not to be today with the S&P 600 small cap index down about 0.75%. The VIX pushing a little bit higher, but still, let's remember, we're at the lower end of the range here. Volatility remains fairly muted. A VIX down below 14 is just very low volatility relative to most historical reference points that I would point you to. So overall, the market, generally speaking, moving higher. You can see the S&P right around the ascending 50-day moving average, or actually right above the trendline support that we've highlighted recently. The VIX remaining low. Breadth conditions, which had come off of extreme levels, are still not bad. They're just not euphoric anymore, and I think that might be an important theme we'll tease out on today's show. Interest rates overall moving lower. You can see toward the end of the equity session, you can see that the curves in the interest rates came down a little bit. So 10-year yield finished lower as bonds rallied going into the close. So the 10-year yield is around 4.27, the long bond yield around 4.41, and the 5-year point almost identical to the 10-year point, right around 4.27. So, one of the interesting takeaways, just to share one of those from our conversation yesterday, I talked with Gina Martin-Adams, who's a market strategist. I think of Gina as as an equity strategist, and thinks about a lot of different things in terms of how they influence the equity markets. And I followed Gina and her work for many years when she used to be on the institutional sell side, and I was up at Fidelity. And Gina was talking a lot about how her general thinking on the Fed in 2024 is that rate cuts will be a lot less frequent and a lot less severe than the market is pricing in. She was thinking that, given the strength that we're seeing, there's no real incentive for the Fed to be lowering rates aggressively. And inflation data, the economic data that the Fed claims to pay close attention to is still, stronger than the levels that they're sort of ideally looking for, which means rates most likely stay higher for longer. Now, growth stocks have done just fine in the current interest rate environment. So we've talked about higher rates being bad for growth stocks, which I often mention. It just hasn't been the case in the last 12 to 18 months because growth leadership names have done quite well, despite the fact that rates are much higher now than they were in the last couple of years. So the 10-year yield remaining around that 427, 430 level, we'll call it. Down slightly from yesterday, but overall, I wouldn't be surprised if rates remain higher than we might expect for a little bit longer. No real change in the dollar, and I think we talked about some of the potential warning signs with my panelist yesterday. The dollar, changing character. A spike in the dollar could be an interesting signal to look for, and you're just not seeing it right now. The dollar overall, basically remaining where it was on Tuesday's close. All right, looking at the commodity space, the DBC, the broad commodity ETF, down about 0.4%. Gold slightly higher, silver slightly lower. One of my panelists, Mohammed El Saeed of HC Brokerage, pointed out, because I asked about gold, and there's a gold souk, which is a traditional gold market not far from where we're holding the conference, which I'm told is a fascinating experience. I've not gotten there yet, but hopefully I'll be able to do that before I leave town at the end of the week. But basically, he was pointing out, in his opinion, if you really want to understand gold prices, look at silver prices. Silver often is a little more of a leading indicator on precious metals. And it's interesting, after we talked about that, silver actually slightly lower. So it was a good reminder that having silver top of mind when you're thinking about gold, pretty helpful. We'll try to look at some of those charts, time permitting, through the course of the market recap today. Crude oil prices slightly lower, with the USO down about 0.3%. Let's get to Bitcoin. It was funny yesterday. We got through most of the two panels and a lot of discussion before Bitcoin was even brought up. And what was funny is, as we were doing the event, Bitcoin was literally going parabolic. Ended up reaching 64,000 yesterday for the first time in a couple years. We are now really close to all-time highs on Bitcoin, and that happened very, very quickly. It feels like for quite a long time we've been speculating on strength in Bitcoin. We've been talking about the long-term thesis for Bitcoin going higher, and other cryptocurrencies like Ethereum and others. You're really seeing that optimism come to fruition. Bitcoin currently trading just above 61,000, around 61,300. Ethereum prices around 34.35, and that's up slightly from yesterday's close. We'll look at the chart of Bitcoin for sure here in a moment. To finish off here, just checking in on the markets on Tuesday, you can see real estate was the number one sector. So, it's interesting. Yesterday, I think you had utilities at the top of the list. Today, we have real estate. So while the overall market conditions, I would argue, still remain strong for equities, while you still see the S&P and the NASDAQ not too far off of all-time highs. It's interesting, you're seeing some defensive sectors get to the top of the return list. Now, real estate, let's be clear, is still a fairly consistently underperforming sector. It's not a great sector just yet by any relative measure, but it is at the top of the list today, with the XLRE up 1.3%. Consumer discretionary, XLY, was number 2. Financials, number 3. They're both up about 0.4% from yesterday's close. On the downside, you had 4 of the 11 S&P sectors actually finishing in the red. Communication services down 0.7%. Healthcare and technology both down around 0.5%. I wanted to finish off just looking down here at what we call the Magnificent Seven. I'm sure you're familiar with this group of names. I call this Magnificent Seven and Friends. I wanted to give myself some room to add or subtract names as needed to as I think they swap into this bucket. It's so interesting when that term Magnificent Seven was coined, and it reminds me of the FANG stocks and FanMag, I remember calling a group for a while. What happens when you create that moniker or that acronym is because at one moment in time they look very similar, right? This is a group of stocks demonstrating a particular market observation, a particular phenomenon. And by grouping them together, you can recognize that it's not just one stock doing one company's thing. It's a group of stocks demonstrating a particular set of characteristics. What's interesting is soon what happens is usually whatever conditions created that moniker, created that group of stocks, things start to change, right? Things start to evolve. Individual stocks start to go on their own paths. And I think Tesla was probably the first example of that within the Magnificent Seven. All of these stocks were just leading growth names pushing up and to the right, consistent outperformers. Tesla all of a sudden diverged, and that was really the first one that really looked very different. Probably Apple was the second one starting to change character. Netflix at times has looked very, very different than the rest of this group. And so I think, to be honest with you, we're going to highlight some of the names: Apple, Alphabet, which all do not look like NVIDIA. NVIDIA and Meta still look like what we think the Magnificent Seven kind of look like, because that's sort of where they're at. So for today, we'll get to that chart in a minute, but for today, Tesla up 1.2%. Microsoft flat for the day. On the downside, Alphabet, NVIDIA both down over 1%. All right, let's go to a daily chart of the S&P 500. As I mentioned, I misspoke. We're not testing the 50-day moving average. It's more the ascending trend line that we've been talking about. And that's a trend line that comes off the October low and the mid-January low, the late January. It lines up pretty well with this close from about 2 weeks ago. In mid-February, we broke slightly before the trend line, below the trend line before gapping higher. That's when we made a new 52-week high. For now, the high watermark of the S&P just above 5,100, around 5,111, and the last couple of days have come off. So this week overall, down slightly off of all-time highs. But again, let's be clear, we were within a rounding error of all-time highs. So today we did close slightly below this level. I'm not I don't have a very hard rule about trendline breaks, although I know some people that are very trendline oriented have very specific rules about breakdowns and retests. I think of them as more visual gauges of what's happening. For me, trend lines are the way that you have a conversation with the chart, right? And when I think about some of the big rotations that we observed over the last couple years, drawing trend lines in a corrective phase and recognizing when that trend line is broken, again, for me, I don't know if that would be the buy signal for me, but it would certainly tell me to revisit the S&P and think about how the conditions might be changing. So I think trend lines are helpful to draw. I think using the annotations just as a way of thinking about what movements we've had, thinking about what sort of levels and rotations we may be anticipating can be really helpful. And so that's what I encourage you to use. So for now, I would say we're still sort of testing this trend line support. For now, the market still appears to be holding on to this general pace of the trend, particularly in the last couple months. Year to date, I think this is a pretty good representation of the overall trajectory in the markets. For me, I think the swing low around 49.50 is sort of the level that I'm looking at. That was the springboard we bounced off before we made that most recent run to a new all-time high, just getting above 5,100 for the first time. If we would, I should point out the 50-day moving average is not too far below those levels, currently around 48.70, we'll call it. If we would break that sort of thing, then you will hear me start talking about further retracements, about further downside projections, about risk management. For now, as long as we hold above an ascending 50-day, as long as we're not making a lower low, which we certainly are not doing today, conditions overall remain quite strong. The momentum overall, I think, on the S&P tells a fantastic story. Now, what's interesting is, as we're making new highs in late February, we're actually making lower peaks in momentum. One of the speakers yesterday, Gautam Shah of Goldilocks Investment Research in Dubai, pointed out he was not a big fan of divergences. And I get his point. I mean, his point was, think about all the divergences that we've seen recently that have not really come to fruition. I guess my counterpoint to that point, which I don't disagree with, that's not wrong. But I would say that if you notice, I think divergences can be very, very helpful, not for big picture rotations. I don't think a divergence sort of tells that the NVIDIA trade is over for good, but it often tells you that we're at the end of that particular phase of the trend and we're probably in a pullback mode. I think divergences a lot of times are very good at identifying pullbacks and not, major market tops. I think you have to have a lot more evidence to declare that sort of thing. And I think looking to the left on the chart, the S&P sort of mid-late July of last year is a good example of where I think divergences can be quite helpful, right? We have a nice strong move, and then you have this move to new highs in late July on weaker momentum. It didn't tell you that the high in the S&P for the year was going to be 4,600 necessarily, or that would be the end of the move and that the bull market is over. It did suggest that this run that we had in the spring months probably fizzling out in the summer. That's pretty much how things played out. So I have a wary eye on the divergences recently as we make new highs on lower momentum. Tends to make me think about the potential certainly for a drawdown to speak of. All right, let's look at a couple breadth indicators as we round off our special edition of the Final Bar. And again, as I mentioned earlier in the week, we appreciate you being patient as we try to figure out time zones and when to record the show. But I'm doing it early morning Dubai time. I think that ended up being the best option for us. Here we have the McClellan oscillator bouncing above and below zero. As I mentioned on yesterday, shown earlier this week, it's been a choppy environment for the McClellan oscillator, choppy environment for stocks, in a period of indecision, I would say. While the long-term trends, I think, certainly remain strong, in the short term, I think there are a lot of question marks in terms of the sustainability of the pace of this move going higher. The McClellan oscillator spending a lot of time below zero would not give me a lot of confidence that the market's just going to continue higher without sort of a meaningful pullback. We are almost to the end of the month of February. We're in the last couple of days here this week. And March, as I've mentioned many times, looking at the seasonal calendar in an election year, March is usually quite weak. So that combined with some negative signs in breadth would tell me a pullback is probably imminent. That's the thing that I have, sort of the base case that I have in the back of my mind. Now, having said that, there are plenty of stocks making new highs. For example, on today's session, about 14% of the S&P made a new 52-week high. So plenty of stocks are going higher. So when we talk about breadth conditions maybe weakening a little bit, let's remember that there are a lot of names that are just continuing to go up. So as long as you continue to see plenty of green on this chart, conditions are quite strong for stocks. The bullish percent index, by the way, one more breadth indicator I want to show you. Bullish percent index is actually hooking back higher. We highlighted this sell signal from the indicator in mid-January. If you look back when we've had a similar pattern where the indicator goes above 70% and then comes back below, and this is based on point and figure charts for the S&P 500 members, it's been a pretty good indicator of a market pullback. That's why we were pretty interested to notice this particular signal in mid-January when the bullish percent index went below, just like it had done many, many times. Now, note the different path in the S&P. This has very much been a different path after that signal. And, the bullish percent index has remained above 60%, and now it's actually hooking higher. It's actually getting close to getting overbought again, getting back above 70%. I wonder if this might have been a false sell signal, and then the real sell signal comes soon after. But it's worth noting that, one of the breadth indicators that certainly looked quite negative in mid-January has not really followed through, and the market certainly has not respected that sell signal that we got in mid-January. All right, let's look at the chart of Bitcoin here. And as I mentioned, pretty impressive. As we were doing the discussion yesterday evening here in Dubai, Bitcoin was literally just accelerating to the upside. So during the Q&A, people were asking about Bitcoin as it was going higher. To be honest, we've talked about the long-term thesis in Bitcoin, and full disclosure, I do on Bitcoin and GBTC. And we've observed the long-term trajectory. And for me, I think, the long-term story from a technical perspective is really breaking out of a significant base and then just continuing to make higher lows and breaking above big round numbers like 30,000, 40,000, 50,000, taking a breather and then continuing higher. And that's just the sign of a strong market environment. The momentum overall has been very strong since that breakout really in October, November of last year. Now we're sort of, certainly getting overextended by many stretches. The RSI almost hit 90, which is incredibly rare on most charts, and certainly Bitcoin included there. It's currently around 81, so the RSI is still extremely overbought, and that usually just means we're going up a ton. When you have overbought conditions, it tells me two things. Number one, the trend phase is positive because we only usually become overbought when the bullish, when the primary trend is up. And so that tells you that overall conditions are pretty good. And that also says a lot of times when we're extremely overbought, we're probably, getting toward the later stages of this particular move. You probably have a pullback looking for a higher low. And I think the challenge for Bitcoin is now that we've become so overextended, you can actually pull back quite a bit and still make a higher low. But by my read, even looking at hourly charts, 50,000, 51,000 is kind of the level, which means it's another 10,000 points plus below where we're at right now as we're recording the show. Now, the weekly chart of Bitcoin, I think, tells sort of the long-term thesis. You can see the all-time highs here in the mid 60,000s and the upper 60,000 range here in the fourth quarter of 2021. We're sort of right in that range yet again. So even though it seemed incredibly unlikely in the fourth quarter of 22 when we're down below 20,000, we have indeed made it all the way back up to retest those previous highs. Bitcoin halving is actually coming up here later this year as well, which usually tends to be a pretty bullish development for Bitcoin. I want to just talk briefly about real estate and just thinking about what the XLRE is telling us. So the real estate sector, the number one sector, and often on a day like this, when you see real estate number one, I'll get a question about, is this a sign of, negativity that a defensive sector is at the top of the list? And I will tell you, making that sort of conclusion from one day's price action, usually not a great thing to do. And the reason is because it's just one day. I think the story on a chart like real estate, XLRE, on something like utilities, the XLU, is looking at the trend in the relative performance. So this is the real estate ETF versus the S&P 500 ETF. it's just been consistently down. So this little bounce that we saw is just one brief move within this long stretch of underperformance. The fourth quarter of last year, when the relative strength started to turn higher, that's when I was thinking about real estate as a potential option. That's when it actually seemed like there could be something to think about there. It stalled out at the February 23 high, and now we've pulled back quite a bit. We do appear to have made a higher low, which I think is constructive. So from a just on a price basis, not a bad pattern. I'd like to see it get back above an ascending 50-day moving average, but the momentum characteristics are actually in line with a bullish phase, and overall it seems pretty constructive. The relative strength is what makes me avoid something like real estate as a legitimate opportunity until the relative strength improves. I'm going to be speaking in a few hours here with Julius DeKempener, the founder of RRG Research, which will be a lot of fun, and we will be talking about real estate and other sectors and how they're rotating around those major benchmarks. Just to finish off the show here, I want to highlight, as I mentioned in the introduction, Apple down very much off the highs. Alphabet coming off quite a bit as well. So, I feel like the Magnificent Seven is becoming less of the Magnificent Seven. I think that moniker may be no longer, accurate, only because there's more and more diversity in the charts, right? If you look at an NVIDIA, it's actually quite a strong chart and moving to the upside. And this is what I think a lot of us think the Magnificent Seven represent, this sort of trade. Alphabet doesn't look like NVIDIA right now. And again, the long-term chart is still fine. The weekly chart is still quite healthy. Let's be clear. I think the long-term thesis on most of these names is actually still quite constructive. But in the short term, Alphabet gapped lower, traded up into that gap. But this week, and particularly on today's session, almost making a new 3-month low or 2-month low for sure. The momentum is weakening. The RSI has dipped below 40 and the relative strength is pretty underwhelming. It's underperforming its peers over the last 5 or 6 months. So overall, I would say charts like Alphabet sort of tell me we're in that pullback phase, right? To be thinking more pullback and less just, long and strong up and to the right. I think charts like Alphabet, failing lower, we're not far from the 200-day moving average. How bullish do you want to be if Alphabet breaks below its 200-day moving average? All right, that's it for our market recap for this abbreviated show from Dubai. Let's get to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I highlighted there at the end of our market recap what I call the not-so-magnificent 7. I just want to point out that while NVIDIA is making new highs, while Meta is holding up, and a lot of the FANG names, are continuing to trend higher. There's no denying that there's a lot of strength there. And the weekly charts are still quite robust, and let's be clear about that. For me, when I'm giving more of a bearish take on something like Alphabet, it's a tactical signal, right? It's more telling us that, or at least telling me that we're in a pullback. I mean, Alphabet is arguably already in a pullback of sorts, and the fact that it's well off its all-time high here, or 52-week high, about 20 points below its high just from about 5 weeks ago. You can see we're actually making a new swing low this week, and we're making a series of lower highs. Now, this is on the short-term time frame. Look to the left on the chart. You can see levels like 120, 115. There are plenty of levels on here. I think applying a Fibonacci retracement right about now would be helpful just to think about some downside objectives and what that might mean. But I'm noting that even though the Magnificent Seven as a theme has been quite strong over the last 12 months, charts like Alphabet and Apple are not certainly showing a position of strength right now. I think they're diversifying or diverging quite a bit from some of the leading names within the Magnificent Seven. All right, chart number 2 in our 3 in 3 is the biotechnology ETF, ticker IBB. I actually had this on the list to talk about earlier in the show. Didn't quite make time for it. But when you think about biotechnology stocks, when you're thinking about opportunities, there's certainly the sectors like technology, communication services, which have been on incredible runs. But if you look at biotech, it's actually just starting to break out. Yesterday, biotech, obviously within the healthcare sector, making a move above 140. It's pulled back a little bit on today's session, down about 1%. But I think this is the broader theme that I'm noticing, right? When you think about the big picture trajectory or the overall picture of something like biotech, it's up near the upper end of the range and just starting to break out here. I think holding that breakout level would be important. If we do pull back, do we hold an ascending 50-day moving average? That was sort of a key factor, I think, here in mid-February as to why this pattern remained fairly constructive. The momentum remains strong with the RSI not even getting down to 40. So I think as long as we make higher lows and pull back to a 50-day moving average, this is a pretty constructive set of charts. Biotechnology is a compelling group potentially for further upside. And I'm interested in a group like this, while you have the NVIDIAs and others, which are, just breaking to new highs, continuing, feeling overextended, certainly if you've missed that trade. Something like biotech, arguably earlier on, something to pay attention to. Finally, high yield spreads. When I think about this market environment, I had a lot of great conversations here in Dubai, just thinking about the short-term risks to this market versus the long-term market structure. And as a trend follower, I have to reinforce that the trend is positive. I think stocks overall certainly are going higher. This chart is a good reminder that conditions remain fairly favorable for stock. These are some of the red flags that I might be looking for. Do high yield spreads expand? We're not seeing that. We're actually seeing corporate spreads incredibly low. So these are spreads for junk bonds or high yield bonds. Volatility, does that remain low? And it certainly is. The VIX is now back below 14. I've plotted these two series inversely just to show how they normally relate to the S&P 500 at the bottom. Volatility remains low, so as long as the VIX remains below 14 or 15, this is a low volatility environment and pretty constructive. Finally, the trend in the S&P is positive, right? Going back to Charles Dow's original theory, are we making higher highs and higher lows? For now, the S&P is certainly doing so. So as long as that trend continues, remain optimistic and remain in this market as much as you can. That's it for our market recap and for the final bar here from Dubai. I'm Dave Keller, the Chief Market Strategist at Stockcharts.com. Hope you guys are all doing well and staying safe. We'll look forward to getting back to Redmond, Washington for next week, but very much enjoying our trip through Dubai and wish you all the very, very best today and always. Take care now.